Hey YouTube, this is Zach with Achilles Financial, and today we're going to be doing an earnings review covering Upstart Holdings Inc., and they trade on the NASDAQ under the ticker symbol UPST. Upstart is a cloud-based platform where they automate the lending process for individuals as well as a lot of smaller community banks. I'm a big fan of Upstart following their most recent quarter because they did something that a lot of other pay-to-play or smaller fintech-based lenders failed to do, and that was they grew significantly, and actually they're now in the process of raising their guidance. So not only did they grow, but they grew profitably. Something we're seeing from a lot of these other smaller lenders is that they are growing but at the expense of net income. Whereas theoretically, if you have a really strong company, in any part of the cycle, they should be able to grow incredibly well and in a profitable manner. This is a company that has had some crazy swings, as you can see by the 1-year percentage ROI chart that you see down here below. The company, after hours, following a earnings top and bottom line beat, as well as a forecasted guidance raise, is trading north of 22.5% after hours. So it'll be interesting to see where they open up tomorrow, but this was already following a very strong performance today. So they opened today at $107 a share and 50 cents. So it's going to be important to note that not only did they have a strong day, but after hours, the company continues to perform very, very well. The company currently has a market capitalization of just north of $9 billion. One of the things that's important to note there is because prior to today's earnings, where they had another large beat, you can see that they had total revenues of $116 million, $187 million, and $210 million from the prior quarters. So the company is growing exponentially. However, their market capitalization is still at a very, very high price to sales ratio. So that's important to note. When we look at those valuations that you can see here on the screen, keep in mind these are not updated as of the numbers that were released today after hours. But the price to sales ratio here was sitting at 13.7%. So obviously the current price was not necessarily taking into account the large beat that was announced today after hours. So this is going to drop much closer to about a 10 to 11 before we see the large increase in share price today after hours. So the question going forward is, are we going to see a large reduction in price to earnings, which is a better metric to track profitability as well as how well a company is performing since the company is profitable? So there's a lot of advantages to watching this company grow, as well as the fact that in terms of revenue growth, you can see that they're averaging more than 200% if we include today's numbers. So instead of just talking about the company by way of share price in terms of the TD Ameritrade version that you can see here, what I actually want to do to showcase some of the weird moves that we've seen from the company and where they went nearly as high as $400 a share this past fall is I actually want to go and showcase how the company's been performing using their numbers from their investor presentation. So this is the investor presentation. You can see that it was released today, February 15, 2022. This is their information. I'm just sharing it and I'll link it down below in the description. But I just want to showcase in terms of some of the growth that the company is performing. This is quarterly numbers. So keep in mind what I just showed was nearly or just above 200 million in terms of total revenue. And in Q4 alone, they had total revenues of 305 million in total revenue. That's a monstrous year-over-year increase of more than 200%. You can see those income from operations is also up significantly. Keep in mind that's not going to be the primary driver. But the important thing to note that I want to highlight is this net income of $58.9 million. You're looking at nearly 60 million in terms of total net income compared to where the company was a year ago, which was in the not $1 million range. So the company is doing very, very well. But the important thing to note is if you look at the year numbers, that they're currently sitting at less than 10 in terms of the total revenue, 10 price to sales ratio, because they had nearly $850 million in total revenue, with total net income, with the vast majority of it, or at least half of it, coming in Q4 of $135 million. So the question going forward is not only are they looking to expand into additional sectors, primarily auto, they're looking at mortgage lending in 2023, but you can see some of the massive increases coming in, but it's important to note what they expect to do going forward. So they have quite a bit of cash still sitting on hand, still have the capability to leverage the information available to them and leverage the monetary value or money associated with it as well to grow into some of these other areas. Because they're profitable, it's going to enable them to grow in a very safe manner, but also in a aggressive way. So the issue I always have with these lenders is they do really well in a strong commercial environment. The question is what's going to happen if they start to experience credit risk and see some of those losses. Because they're doing a lot of the originations, they're going to be able to mitigate some of that risk. The question is going to be, how do their borrowers or how do their banks perform in those same situations? So the company continues to have very, very high numbers in terms of the transaction volume. You can see a large percent of those loans are fully automated, which is incredibly beneficial, and they're doing so profitably. What I want to highlight though is this outlook that you see right here. So they actually increased the total revenue. This was not 1.4 billion. So they're raising full year fiscal guidance. And they're expecting to be around that same contribution margin. So they're looking to spend to grow, which is not a bad thing because they're trying to grow that revenue. So it's going to be important to watch that. And what we're expecting to see is the introduction of auto as well. So there's a lot to like about Upstart. I think this is a company that has a lot of value in terms of a trading vehicle as well because of the volatility associated with it. And as such, I would look to not necessarily invest all at once, but rather to dollar cost average into a position like this because it does have the capability to have some major swings. The company is growing very well and they're growing very profitably. But that being said, it is still a up-and-coming fintech player, and as such, they have the capability to have some major swings in share price, as we saw when they went from nearly $400 a share down below $100 a share. So just be watching it. I feel like it's something that you can definitely nibble at, but not necessarily want to buy in all at once, especially following such a strong earnings report. So that being said, one to watch. Keep in mind, I'm not a financial advisor. I'm just some guy on YouTube giving you his opinion. So if you have any questions, feel free to drop those in the comment section down below, or if you want to talk about stocks, we do have a Discord and that is linked in the description. If you find this content helpful, please leave a like and subscribe. Thanks. Talk to you later.